Hi, I'm Mark King, Investment Editor at Columbia Threadneedle Investments. Joining me today is Toby Nangle, Co-Head of Global Asset Allocation and Head of Multi-Asset EMEA. And we're going to discuss some of the key themes driving markets. These include, of course, the election of Donald Trump and the ongoing political scene in Europe. Toby, let's start with the US. What have been the early impacts of President Trump's first days in office?
Well, they have been very early days. We're in single digits at the moment. But in these early hours of the Trump presidency, we haven't seen risk assets fall. We've actually seen them continuing to rise through, a little bit choppy, but broadly up. And also bond yields. They rose quite meaningfully after his election. They've continued to rise up.
Are you expecting Trump to enact all of his protectionist policies, or will he scale back his ambitions when it comes to, say, trade agreements and tariffs? What might that do to corporate earnings?
Well, as you know, corporates across the United States and across the world, their supply chains traverse national boundaries a number of times. So putting tariff barriers in the way could really be quite devastating for a number of companies' profitability. It could also jack up inflation in the United States, which would hit the voting base quite a lot and potentially reducing real incomes and growth. So all in all, it seems to be something that, while big on rhetoric, we're not really looking for a complete follow-through, and that would be a real risk event this year.
So with all that in mind, what are your growth and inflation expectations for the US?
Well, last year, in 2016, we had a profits recession in the United States and also an inventory downturn. Coming out of that, the economy's got a good amount of momentum towards the end of last year, and we see that continuing through this year. But for 2017, we're looking for growth of around about 2, inflation around about 2.25. So fairly steady, but not a bad result.
Moving to fixed income, Toby, there's been much said about the bond bubble having burst. If global growth does pick up, could the bond market melt down?
Well, bond yields are still pretty low. They're still near the bottom of a 500-year range. And that's for good reason. We've had secular disinflation, cyclical deflation, and you've got ECB, the Bank of England, the Bank of Japan going out and buying vast amounts of bonds. So it's good reason why bond yields are low. But as all of those start to ebb away, specifically the cyclical downturn, then there's all of those supports of bonds prices or pushing down yields start to ebb away. And we see that continuing through this year.
Europe faces plenty of uncertainty this year with key elections across the region, not to mention ongoing fallout from the Brexit situation. So what does all this mean for risk assets in Europe?
Well, you're right. The big risk event from markets' perspective in Europe is the French presidential election. After Brexit, after Trump, these have been brought in one package in investors' minds as anti-globalism, and another anti-globalist movement is understood to be the rise of the National Front in France. Now, we see that a very high likelihood that Marine Le Pen, the leader of the National Front, going into the second round of the French presidential election, but a semi-replay of the 2002 French presidential election when her father, Jean-Marie Le Pen, went into that second round, and pretty much everyone who voted for any other candidate united against the opposition. I know that pollsters are much distrusted, but those are the sorts of things that are coming through consistently in polls, and we can't see quite how 10 million French people will be dissuaded from that course of action from today, given that we've only got a few months to go.
So what does that mean for European equity markets?
Well, just because something's not very likely, if it has a devastating outcome, which it really could set and train the motions of a devastating outcome, doesn't mean that investors shouldn't be focused on it, and they are indeed focused on it. Holders of European equities should be rewarded over this year if that outcome does not come into fruition. And so there is a risk premium, there is danger money on offer for holding European equities because of this low probability event potentially happening. And so they should be quite well rewarded if it doesn't come about.
Toby, thanks very much.